Hello everyone and welcome to this week's FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Thank you to those who are joining again. I see a few of you have messaged, so it's good to see you again. Good to hear from you again, and I'm glad you've come back. For those of you who are joining us for the first time, welcome. In these sessions, we like to take a look at some of the major macro stories which are moving financial markets at the moment. Preview the upcoming week using the economic calendar on the screen that you can see in front of you, and then take a look at some charts, and then I give my analysis. Of course, as ever, please feel free to jump in if you've got any questions, if you've got any comments, and if there's anything which I've not covered which you would like me to, and I'll always do my very best to oblige. But if there's no comment to start with, I will just crack on. Hopefully you can all see my screen in front of you. That's the OANDA MarketPulse website, where myself and my colleagues post our content on a daily basis, going across all the time zones. So hopefully, no matter where you are joining us from, there should be something there that suits your needs. It's also where you'll find the recording of this webinar later on today, hopefully, and also where you'll find the economic calendar. Now, the economic calendar I personally use to preview the day ahead, look to see if there's any major announcements which could potentially influence the chart so that you're prepared for them. Again, it depends how you trade as to how you will use them, but I think regardless, it's always worth being aware of how your positions can be impacted by external events, especially those which you know are happening. Now, I'm going to configure these charts by what it is that we are looking at in terms of the charts today. So I'm just going to highlight the things which I do normally set this up beforehand, but today I've just become aware of the fact that I forgot to do it. So I'm just quickly doing it now. Again, if there's anything you want me to cover that I'm not touching on, then by all means do let me know. Just going to look at medium and high volatility events, which again, as I always say, may leave the odd thing out, but it's usually not the most important things, and it's nothing that I think is going to have a major influence on the actual trading week. In terms of how the week's going so far, I think it's safe to say that it's been a slow start. If you are looking at FX markets, it's been a slow start. If you're looking at stock markets as well, commodity markets is really where the action's at right now. At the start of this week, I must say, the European update and the pieces which I've got planned for the rest of the day really do touch on the fact that we are seeing some really interesting moves in some commodity markets right now. Looking at oil, gold, even if you look at crypto markets right now, big moves. Stock markets are a little bit more patient. I think the G20 at the end of this week is the reason why. The G20, which has been made all the more prevalent by the fact that we are going to have a meeting with US President Trump and Chinese President Xi Jinping, and that will have a major bearing on the trade war, which is very much underway between the two countries, whether we're going to see tariffs on the final $325 billion of US imports from China, retaliatory measures, of course. Talks did break down last month when it seemed that both sides accused the other of reneging on promises that were previously made and causing the breakdown in these negotiations. It's hoped that Trump and Xi, by talking directly, can help resolve some of these issues, help talks to progress, at least restart, and avoid the need for further tariffs to be imposed. I do think it's in both parties' interest to do so. What's interesting is that markets seem to be pricing in a low probability of that happening. And what I'm basing that on primarily is Fed expectations. If you look at this CME FedWatch tool here, this basically takes Fed's funds futures and uses them to come up with probabilities for where interest rates are going to be moving in upcoming meetings. What you'll find interesting here is the probability that rates remain on hold at the next meeting are 0% based on Fed funds futures. That's quite incredible. Markets pricing in 100% chance of interest rates being cut. What I find absolutely remarkable is that they're pricing in a 40% chance of that cut being 50 basis points. Now, when we've been going through a tightening cycle for so long, we've seen 4 interest rate hikes last year of 25 basis points each. every move that we've seen has been a 25 basis point move. To suddenly cut by 50 basis points, having decided not to move at all in June, and when the economy, as Trump has said himself, is thriving, when unemployment is at multi-decade lows, that seems a very drastic action for non-drastic times. It would suggest that the Fed is very much concerned about the prospects of the trade war. The fact that they held off in June suggests that they are, like the rest of us, watching to see how these discussions go at the end of this week. And it just seems like a very drastic measures. We go back to December at the end of this year. And what this effectively tells us is the markets see a probability of around 72% that we'll see at least 3 rate cuts this year, and more than 30% that we'll see 4. Again, that's incredible. We're at the end of June. There's only so many meetings left. So that suggests that we're going to see some very severe policy responses from the Federal Reserve. That, to me, suggests that investors are not expecting anything positive from this G20. And if we do get a positive end to this G20 meeting, then I think it'll be very interesting to see how markets do respond to that, because that will tell us a lot. That will tell us whether this reaction that the markets are pricing in currently, is it just a growth story, or is this heavily an inflation story? Because we know that we have seen inflation slowing a little, particularly on non-tariff goods. Do the markets think that warrants a 3 or 4 interest rate cuts this year, or 75 to 100 basis points of rate cuts this year, even if trade talks do improve and global growth does not slow down as much as feared? I think it's really intriguing. I think that's what makes this week so important, and maybe why we are seeing such apprehension at the start of this week. Now, the other major story from a geopolitical standpoint is the events that we're seeing in the Gulf of Oman, near the Strait of Hormuz, where we have seen early last month 2 ships were sabotaged, and both Saudi Arabia and the US blamed Iran for those attacks, which Iran rejected at the time. Since then, we've then seen a ship, 2 ships attacked. That was a couple of weeks ago, and then a US drone was shot down over the Strait of Hormuz as well. Now, the last one Iran has taken responsibility for, but while the dispute has arisen because the US has said that the plane was in international airspace and Iran has said it was in Iranian airspace. So these things are obviously very difficult to prove, but we have seen an escalation on the back of that. In fact, it was reported that Trump's team ordered a retaliatory attack on certain locations in Iran, and that was called off at a late stage by Trump himself when he learned of the number of casualties that would be inflicted on Iranian people if that attack was carried out. Instead, we have seen sanctions now imposed on a number of senior officials, including the supreme leader. Now, that is still an escalation of sorts, not as much, of course, as it would have been had that attack actually been carried out. So I think we can all breathe a slight sigh of relief on that front. The question is, how much is this going to escalate further? Will Iran still feel backed into a corner? Will we see them lashing out? Are we going to see further attacks? I think people at this point are almost expecting further issues in the region, and do not see this de-escalating at this point in time. Now, at the moment, this is primarily having an impact on oil markets, so we're not seeing it have broader negative repercussions. But the more this escalates, the more this has the potential to have knock-on effects elsewhere. So it's certainly something to be keeping a close eye on. In terms of other economic events this week, it is a much quieter week than last week. That's not to say that there isn't anything to be watching. The one thing that we can see on the calendar there for Tuesday is the OPEC meeting. Now, I know this is a FX webinar, so I won't go into that. But all I wanted to say that is you should ignore that. This was the initial date that OPEC was meant to meet, and OPEC plus its allies was meant to meet a day later. to discuss a possible extension to the oil production cut to the end of the year. This has now been pushed back, and again, I think this is related to the G20 summit that will now be held at the very start of July, so next week. So you can ignore that, even though it is still sitting in the calendar. In terms of what we have for the rest of this week, like I said, there's a lot of low tier piece of data. Today, for example, we've got medium tier data, things like consumer confidence, new home sales. Again, the type of data which people do monitor, and you can see have little impacts on the currency markets, but I don't expect any major impacts. I think Powell's speech later on today could be very interesting, especially in light of the more dovish approach that we saw from the Fed last week. What will be interesting from my perspective over the coming weeks is whether Fed officials comment on market positioning compared to what their own expectations are, and whether the two are aligned or whether the market's being too aggressive. Because my inkling is very much the latter, as you can probably gather from what I've been saying earlier on in this webinar. So I think that's going to be interesting to look out for, because we've seen a big sell-off in the dollar over the last week, ever since the Fed released its new economic forecast, and we heard from Jay Powell, and we had the statement, of course, from the entire Monetary Policy Committee. We've seen a big sell-off in the US dollar since then. Again, I do wonder whether it's completely overblown at this point. Tomorrow morning we will get an RBNZ rate decision. You can see here that expectations are for no rate cut, interest rates remaining on hold at 1.5%. You'll remember, of course, that they did cut rates earlier in the year. Now, while we are expecting interest rates to remain on hold, they have signaled another rate cut for this year. It's just a case of when. Market participants are expecting that to be August, but there is a 20% chance, according to Bloomberg, that this will happen at this meeting. So this is a relatively live meeting, even if expectations are for that not to be changed. So that would be interesting from a Kiwi dollar perspective, especially at a time when the US dollar is seeing some weakness. Also tomorrow we have the inflation report hearing from the UK, from the Bank of England Governor Mark Carney. His colleagues will appear before the Treasury Select Committee in Parliament. I'm not expecting too much from this, same as I wasn't expecting too much from the Bank of England last week. The simple reason being that there's so much uncertainty right now. We're in the midst of a leadership contest for the Conservative Party, de facto Prime Minister. We then have Brexit to deal with, the new deadline being the 31st of October. Markets are expecting no rate cut between now and this time next year, and I think that's pretty wise given the information which we currently have. Now, that may change over the next 6 months, but for now, I think that's pretty accurate, and that makes the inflation reporting probably not as major a market event as normal. I wouldn't expect an enormous amount on the back of it. Again, famous last words, so please don't just sit on what I'm saying and assume that that is very much the case. These things can be unpredictable at times, but I wouldn't expect too much on the back of it. I also think, given what's happening with the leadership contest, etc., that it's probably going to be highly politicized. Maybe a lot of focus on Carney himself and whether who his successor will be, whether he would be interested in staying on in the role, which I don't think he would be. What he thinks of Philip Hammond's comments at the Mansion House speech last week in relation to Brexit and no deal Brexit in particular. Again, highly politicized. Anita's asked about the oil report tomorrow at 10:30. Yeah, so that's Wednesday is at 10:30 EST, 3:30 if you're here in the UK. That's the report from the EIA. That's the one that's more closely followed. The API report is released on Tuesday evening in the UK as well, and Tuesday afternoon, obviously, if you are in the US. They show up. They're one of those events that shows up on here as a low-level piece of the tier data. I think that's wrong. I think they're both far more important than that. And we've seen the impact that they do have on oil markets, and to an extent, the knock-on effects that you can see, for example, in the Canadian dollar. But for some reason, on this calendar, they do show as low-tier events. So that's one of those ones that does seem to get away. So yeah, thank you, Nita. That is naturally an important economic release that we do see. Just doesn't show up when I do narrow this down. Durable goods orders, I always say, is one of those releases that's underappreciated. It's down as a mid-tier event, but I do think we can sometimes see a bigger impact on the US dollar, and it's always one that's just always more interesting. I always find as well. It can be quite volatile, particularly overall durable goods orders, because it includes things like aircraft carriers and things like that, which are obviously massive items which can distort the data. Aircraft, it's like aeroplanes, etc. However, I think it's a really interesting piece of data when you look at it from an economic perspective, because these big orders are purchased now. I think it incorporates an element of near-term views of companies if they're making these large purchases, but also long-term views as well, because they are large goods that tend to last 3 years or more. So it's investing in IT, for example. It's investing in equipment. It's investing in a whole manner of large items that are big investments. So that I think it says a lot about now, but also the future as well. So when we start to see deterioration in these numbers, then I think that then this becomes far more prominent. I've been asked by Keith, the USD appears to be oversold across many instruments, my opinion. Well, I mean, I think the dollar was oversold about a month ago, maybe a little bit longer. We have seen a big sell-off since then, and when we say big, when we're talking currencies, the percentages can be deceiving. So the dollar is off a couple of percent over the last week, but that's a massive jump down when you look at it on a chart compared to where it's been trading prior to that. It's down around 2.5% from its peak. Again, doesn't sound like much when you think that equity markets can fall that in a day, but in currency markets, that is actually quite a leap. So I do think it has been oversold. Whether it is still in that territory is potentially debatable. I think it's going to be interesting to see over the coming days, maybe how that actually does shape up. But we have seen a bit of a corrective move already. So without meaning to sound obvious, it's not. I don't think it's quite as oversold as it was. Does that mean that there's maybe more scope for more downside? Yeah, I mean, we'll look at the charts in a second. I think we look at something euro dollar, and I think we've seen a nice little breakout, and there's potentially some more upside to come. So from that perspective, you could argue it's still therefore oversold. But I think from my perspective, I would say I think that's kind of maybe a little bit past. That doesn't mean we can't say something can be not oversold, but also can be bearish, if that makes sense. Thursday and Friday, we've got GDP data from the UK and also the US. I'm not going to get too hung up on that because it's now June, so this is first quarter data, third revision of the data, so tends to be less impactful. I think the more important one on Friday is going to be the inflation data, core personal consumption expenditure price index, being the Fed's preferred inflation measure. Expected to remain at 1.6% below the Fed's target, and it's been on a bit of a downward trend. Personal income and spending, I think, is always interesting as well. Eurozone inflation, less impactful because we know which way that central bank is headed, and it's been struggling with inflation for a long time. And then, of course, we've got the G20 meeting starting on Friday, which I covered earlier on in the webinar. And with that, we will move on to some charts. If I've missed anything, again, please do just say. Always happy to cover these things, but let's just push on to the euro dollar chart, because this is what I was just referencing then in response to Keith's question. So around these areas, I think the dollar was starting to look quite oversold, and not necessarily just by these indicators below, the momentum indicators below, although we were obviously seeing that we were seeing slight increases in this stochastic, for example. Same can be said with the MACD, so potential indications that this is a market that was starting to show divergence. Again, another oversold indicator here. But it was also the fact that we would just, every time we made a new low, we just struggled to hold on. We made a new low here, we struggled to hold on. We made a new low here, we struggled to hold on. These are indicators that you don't need momentum in. You don't need the momentum indicators in below to actually tell. You can see that immediately with your eyes. We then rotated off to 61.8 fib. I remember saying last time I added the 78.6 because we've been in such a long downtrend that you can often see a bit of a deeper correction, and it still be a corrective move rather than a continuation of a downtrend. It fell somewhere between the 61.8 and the 78.6, and we've rotated higher. So very much worth keeping an eye on, one worth bearing in mind in the future as well. So we initially broke through this descending channel before coming back inside. I wasn't too worried about the fact that we came back inside because the break had happened. It did suggest that the market had turned more bullish, but since then we've just been on a rally higher again, driven by that dollar weakness. What I like about this is we've taken out that previous high. We've also gone through the moving average band. So that suggests to me that this is a market that's potentially turned bullish. So this is, again, referencing what Keita. Here, I think the market was oversold and we were seeing signs of it. Here, I think the dollar is potentially still looking bearish, even if it's not necessarily oversold at this point. Now, we're starting to see it pound gains. I'm always a little unconvinced when we see it break through what I think is an interesting level, and we already start to turn lower. But we can't; these things can't move in a straight line. We'd seen 4 big days of gain, so I'm not overly concerned about this. If we're looking for potential initial support, then I think this kind of 113.50 could be interesting, prior high, and we've also got the 200-day moving average coming in there, so that we could potentially see it find some support here. I think we may have run into resistance early, just because when we look back at this period back in March, we were running into resistance around these kind of 114, 114.50 area, and we had done on a few occasions previously. So perhaps that's why we are seeing a little bit of profit taken at this point, especially on the back of such a strong rally. But I still think this is looking bullish in the near term. I think when we head into, if we head into one of these 115s, then it starts to become more interesting, because we are looking at longer term support and resistance levels. But for now, we're seeing it pair gains. We're not seeing necessarily reversal signals at this point in time. And again, if we come back towards these 113.50s, then that could be a potential resistance support area. Below there, again, 113 is one that stands out, having been an interesting level previously back here. But also, if you look historically, that seems to be the case as well. I'm always a fan of Fibonacci levels if it gets to it, but I'm not going to add it on now just because we've only seen it turn lower this morning. So I don't want to just clutter up the chart for the sake of it. Cable is a bit different. We have seen it bounce higher, but for me, there's still a number of factors which make me worry about the pound. I do think a lot of Boris is priced in, and from that perspective, there could be some upside risks for the pound, being that if Boris is so heavily priced in and he messes up this next month, what was being viewed almost as an easy entrance into number 10 because he had such a lead. If that messes up, or if even the odds close, then that could be seen as a bullish signal for the pound, because Jeremy Hunt would be seen as far more sterling friendly. He would be seen as the more favourable candidate for getting a soft Brexit, would be seen as a clearer candidate for delivering no Brexit at all, maybe via a second referendum, although you won't hear him promise that, but of the two, he'd be the more likely. So that type of thing could potentially give you some near-term support for the pound, but I still think the route to number 10 for Hunt is still very, very challenging. He's effectively relying on Boris really messing this up, and I mean, based on recent reports, obviously with the police being called out to his house, etc., it seems he's maybe given that a good go. I'm not sure hiding away from the media, as his tactic has been in recent weeks, is necessarily going to help him at this stage, which is maybe why he's going on a bit of a charm offensive, but he's got to back that charm up with substance. So it's going to be an interesting few weeks from that perspective. The odds still very much favour Boris Johnson, and for good reason when you look at how the Tory membership view Brexit. And therefore, you're basically looking now at a Brexiteer wanting to deliver Brexit at any cost, and a Remainer who is a reformed Brexiteer wanting to deliver the safe Brexit. Now, I think the Tory membership will favour the former, but there's always surprises in politics, so let's see how that one does pan out. But I think if you do see Jeremy Hunt close the gap in the polls, then that could potentially favour the pound. But I think something like some of these other currencies are potentially have more potential against the US dollar. We're running into resistance over here around the kind of 128s, so there's potential for a bit of a corrective move here. Obviously, that comes around the recent peak, but also prior support as well. I think this one's just very volatile, very politically driven, very volatile. If we break through 128, then of course 129 could become interesting, and 130 above there, we may enter into this kind of new zone. There's so much more driving it than what we would normally pay attention to. That's the thing that worries me. When it comes to politics, things are, as ever, very unpredictable in many ways. Aussie dollar, we have seen a rebound in the Aussie dollar versus the US dollar, but not a particularly strong one. Not one that I think is going to give me my long-held wish of wanting to break through 71, through the moving averages, through the previous peaks, and really explode us to the upside. The reason for this is because the Australian Central Bank is already engaged on interest rate cuts. They have already left the door open to another potential rate cut this year. We saw from a couple of weeks ago that I think, was it Governor Lowe said that they are working based on market expectations, and market expectations are for another rate cut this year. Clear indication that that's their base case assumption as well, unless things start to take a turn for the better. So something to bear in mind here, which may continue to earn the Australian dollar. If we break through 70, then that becomes very interesting in 71, but I'm just not particularly hopeful, unfortunately. Dollar CAD, on the other hand, is way more interesting because we have seen a breakthrough the rising trend line. We did see a corrective move, just like in euro dollar. We didn't breach the 61.8. We actually ran into the 61.8 pretty much and then rotated lower. And since then, we have seen that US dollar weakness really kick on. We've gone through the previous low. We've gone through the 200, 233-day simple moving average band. So this is a chart which really does interest me. Again, we saw a little bit of a corrective move here, but already we're edging a little bit lower. I am going to pay attention to these momentum indicators for signs of a weakening trend, because I do think there could potentially be corrective moves along the way. I don't think there's anything wrong with that. That's natural and perfectly healthy. In terms of support below, just keeping an eye on these previous support areas around 131 for again another area where we could potentially run into a little bit of support. Momentum indicators, the moving averages on the MACD don't look too bad. The histogram's looking a tiny bit soft, as is the stochastic, so potential red flags just popping up here. Sterling CAD is also looking a little bit soft. Again, doesn't surprise me based on the previous charts we've been looking at. I've just been told that there's no audio. If someone can confirm if that's the case, because I'm not entirely sure why that would be. I've been told that there's only charts. I'm not entirely sure why that audio will have become disrupted. Can anyone confirm that you cannot hear me? No, I'm being told that the audio is still good, so I'm not sure what the issue there. I'm not sure if I've been muted. If you've muted me by mistake, Nita, I'm sorry. But I will crack on, and if and you can always. Oh, okay, perfect. Back on. Cool. Let's crack on. No one wants to see me sit here talking to myself while looking at the charts. So thank you for letting me know anyway. And if any of you have any issues in the future, please do just speak up. So we have hit this support here around these kind of 167.50s. We are starting to see this divergence form. You can see it on the stochastic. You can see it on the MACD histogram. You can see a flattening in the MACD moving averages as well. Again, these divergences, they don't mean that we're going to see an end of the trend, but when they are occurring around long-term held support, even if it is in a big area like 66 through 67.50, that's just a sign of a weakening trend. So we're clearly seeing some profit taking already kicking in here. We may see it come back to the August 166. We may not. We may see it break these previous lows. We may not. I think the important thing is here, this looks like the trend is softening to me. If we see it break 166, or even if we see it break 166.75, these may change, and if they do, then great. That confirms the move lower. Well, the thing I'm always intrigued in is when these moves here are not being confirmed here, and at the moment they are not. So I think that's a red flag as far as I'm concerned. Kiwi dollar, very much like the Australian dollar, we have seen these moves higher in the Kiwi dollar. There's just not much conviction from my perspective. We are potentially going to see a rate cut this week. We are, it seems likely to see a rate cut at least by August. So this is two central banks which are moving in tandem. We may see the Kiwi dollar perform well, just purely based on the fact that the US dollar was oversold, and that the US dollar may come under some further pressure, which may lift this pair. But I just think other pairs we will see it get capitalized on more so potentially than the Kiwi dollar. Again, famous last words. We've got this Fibonacci retracement on here. I think this is a really interesting area around 67, because you've got the 50 fib, you've got the culmination of the moving averages and its price support and resistance. If we see it break higher, it's not the end of the world. But I think this 50 fib, this area here, could be really, really interesting for this pair if we do start to approach those kinds of levels. The one thing I think stands out here is the fact that we didn't make a new low here. So we may not necessarily see this making new lows on the back of the Kiwi Dollar, Kiwi Central Bank cutting interest rates, but that doesn't mean we can't see this entering more of a range-bound type scenario compared to other charts. And speaking of other charts, I'll go to the US dollar versus the yen first, because I think this is one of those really interesting ones where we are seeing quite a clear trend forming, unlike, for example, the Kiwi dollar versus the US dollar. We didn't see any kind of a corrective move here. This is one of those ones where I just added the fib too early, I think. We came back, we didn't even reach these 109s really. The 109 had the potential to be initial resistance for the pair. Instead, we fell short right at all resistance around 108.70, 108.60. We had a bit of a consolidation, and then we edged straight low. We've gone through the 108, and now we're heading lower again. Now, if we look back historically, as I've said to you before, 107 then strikes me as being potential support, having done so before, and then it seems the big numbers just seem to come into play always. Aside from that, 106 and then 105. 105 is the next big one for me, with it having been historically a very notable area of support and resistance. But I think I'll be keeping a close eye on the 107, 106s along that way, because they have been respected previously. If we do see a rotation to the upside, then 108, of course, is that initial level of interest. I can't add any fibs on there at this moment in time because there's no clear sign that we have hit a low yet. So at this moment, the trend looks good. The moving averages on the histogram are edging lower. The histogram itself are actually showing some little bits of divergence, potential starting to see divergence on the stochastic as well. So potentially something forming here, but nothing too clear cut, I don't think, at this moment. The yen is just generally performing quite well right now. So you can see that sterling's also struggling against it. We saw consolidation here, rotated off that prior support term resistance 138.50, rotated low, made a new low. Now what is interesting here is that low was made on clear divergence on the MACD moving averages, the histogram, a little bit of flattening on the stochastic as well. And it also, you can just see with your eyes, we didn't make much of a new low before we were rotating higher. We are only seeing consolidation again though, so there is potential that this could come under a bit more pressure, but if this starts to be confirmed by more and more divergence, then that really does suggest a trend weakening. And when you're coming off such a strong trend, we're seeing this flattening out. You can see the way my mouse moves. We're seeing a significant sell-off to the downside, and then we start to flatten. If this continues to be the case, then this would look to me like it's potentially prone for a bit of a correction. It's just a case of when and whether this divergence continues to persist, but this looks like a weakening trend from what I can see. And euro yen as well, as with dollar yen, as with the chart we were talking about earlier, I think it was Kiwi dollar, we failed to make a new low here, which is quite interesting. And this actually doesn't look too dissimilar to actually the Kiwi dollar chart as well, because we are creeping high, but we're not seeing enormous upside momentum forming. The interesting level here becomes around this kind of 123 through 123.50 here. We've got the 38.2 fib, we've got the prior resistance. So potentially a level of interest here, potentially a double bottom forming. So if we can break and hold above there, then that could be a really interesting signal, especially if that's followed by a move through this Ichimoku cloud. The only thing that makes me a little bit cautious about the break of this double bottom is the cloud itself, and the moving averages that we've seen, and also that prior resistance. So I'd really like to see a breakthrough 124.50 before I start to look at this in a more bullish manner, but perhaps that's just me. If we did this double bottom, it's 123, say, through 121, so potential projection of around a couple of hundred pips, maybe taking it towards 125. Again, these things are never precise, it's always a matter of judgment. I think 124.50 is the real big level here to the upside as far as I'm concerned. Assuming we even get there, we haven't even pierced through these kind of 123s yet. So a few things to look out for there. Again, probably not one of the most interesting charts as far as I'm concerned. I think we've highlighted a number of other charts which are far more interesting. And if you aren't in the US and you do have the ability to look at things like gold charts, oil charts, I really think they're really interesting right now as well. The dollar moves playing havoc with gold. We're seeing it now trading at 5-year highs, 6-year highs. Oil as well, obviously very interesting given everything that's happened over in the Middle East. So that's really interesting right now as well. So there's plenty to look out for, plenty of stories developing over the next few days, lots of data. So hopefully it should mean that everything is very interesting for you all. We've got no more questions, so I will wrap things up here. I won't be doing the webinar next week. My colleague Ed in New York will be taking the reins. I'm off for a week, so you will be able to enjoy his company. Anyone who's been on these webinars before will, I'm sure, remember Ed. Like I say, he's joined us for the monthly ones before, so I'm sure you will very much enjoy his webinar. Nita has asked to see an oil chart, so I'll just bring up WTI, for example, here. Again, you can see that we've had plenty of volatility forming here. We had this little double bottom here forming around the kind of $50 mark. We had the neckline here around the kind of late 54s. We've broken higher. We've run into some resistance around the kind of 50 fib, and again, this prior area here of support and resistance, this area around 57 through 58, so we're seeing potential resistance there. I think this kind of entire area actually between 58 and 60 is 58, 50 and 60 is really, really interesting. But again, quite like the a few of the other charts, like the pound charts is very politically driven. When we're talking about what's happening in the Gulf right now, this is not a planned economic event that we can see on the calendar. These tend to be out of the blue. And at the moment, I think there's a lot of geopolitical risk which is being priced in, which is helping to lift these prices from a relatively oversold condition, to be fair. But we've also got, like I say, the OPEC meeting at the start of next month. So we'll see how these talks go. Again, quite linked to global growth as well. So I think the US-China trade talks are really important for oil, also for the global economic outlook, and therefore the demand side of the equation. So many factors. I'd love to go into more detail on this, but we have run out of time. I'll be putting a piece up about oil later, Nita, so if you want to check that out, and then if you've got any questions, please do just reach out to me on Twitter, and I'm always happy to help. But I do think this is a really interesting chart right now. But apart from that, thank you all very much for joining us. Please do check out the recording if you want on MarketPulse on YouTube. Thank you, Nita and Michele, for your wishes on my holiday. I'm very looking forward to relaxing and having a little bit of time away from everything. But yeah, check out the recording of this later on YouTube and MarketPulse, and I will also be tweeting it out. If you've got any questions, ask me on Twitter, Craig_Forex. Check out the podcast as well each week, OANDA Market Insights. You can download it on iTunes or wherever else you get your podcasts, and that's released at the end of the week, previewing the coming week. And apart from that, most importantly, I very much wish you all the very best of luck with your trading, and hopefully I'll speak to you all again very soon. Have a fantastic week.